Good afternoon. This is Gabriella Dara, and I am the moderator for today's webinar. On behalf of our team at HBKS, I would like to welcome you to today's discussion about the impact COVID-19 has had on the global economies and financial markets, and the investment approach that HBKS is taking during this pandemic. Our session is scheduled for 60 minutes and is being recorded. A copy of the recording and presentation will be emailed later this afternoon. Please note that all attendees are set up in listen mode. You may submit your questions in the control bar. We will address them at the end of the presentation. For specific questions regarding your individual financial plan and investments, please contact your HBKS advisor. Since this is an evolving situation, we encourage you to visit our website, hbkswealth.com/COVID, for the latest news and commentary. At this time, I would like to turn the presentation over to our presenter, Brian Sommers, who is the Chief Investment Officer at HBKS.
Thank you, and good afternoon, everyone. During this hour, I will provide a brief update on the progress to fight COVID-19 based on some of the research we get at HBKS. I'm also going to talk about both the short-term and long-term impact that it's having on the global economy and the stock markets. Then I'm going to review the government stimulus response to the pandemic, and then I'll discuss some of the potential recovery scenarios we might expect to happen when the pandemic is over. And then finally, I'll talk about how the HBKS investment philosophy can help keep our clients focused on their long-term goals and objectives. So first, a brief update on the progress to fight COVID-19. And let me just start by saying that no one, especially someone who is not an epidemiologist, can accurately predict where the trends will be in 1 week, 2 weeks, 3 weeks, or at any point in the future. This pandemic is unprecedented and unpredictable, which is why we have seen the historic volatility in the global markets over the past month. And so while I'm not a health expert, I can briefly just provide a summary of the facts as we get them from our research providers. So overseas, the trend of new cases continues to improve just about everywhere in Europe, even in Italy. And the mortality rate is beginning to show signs of slowing the past few days. The same can be said for China and South Korea. Although many people do doubt the accuracy of the data that's coming from China, and the data is very fluid and continues to change, but it appears that other countries are a few weeks ahead of the United States in seeing improvement, especially in the mortality rate. You can see this chart that we're showing, the number of new cases in many countries in Europe. The number of new cases, that curve is already bending and beginning to improve. The mortality rate, as of this chart, is not showing improvement. However, I remind you that this is based on 5-day moving averages. And so just in the last couple of days, we're beginning to see some improvement in the mortality rate. So that should begin to show up in the next several days as the 5-day moving averages reflect the most recent data. On March 27th, the US passed China and now has more cases of COVID-19 than any other country. The growth rate of confirmed new cases in the United States has been trending downward, as seen on the chart on the left. If you just go back to if you look on the chart on the left, the growth rate is actually on the decline, and it has been declining, really since the latter part of March. However, the mortality rate on the right-hand side is still at very high levels. I don't expect an easing of the social distancing that's being practiced in most part of the country to be eased until these numbers improve. Now, as for the data coming out of the specific states, the rates of increase in California, New Jersey, Michigan, Illinois, Connecticut, and even Florida have all slowed, but are still very high. In Florida, they have finally imposed a lockdown, so we would anticipate that the data would continue to improve there. The data is also improving in New York and the state of Washington. On the other hand, we list some states here, Georgia, Louisiana, and Idaho are a few examples of some specific states where the data is not improving. And again, until we see broader improvement across all of the states in the United States, the business closings and restrictions on leaving your home are likely to continue. Even with these improvements in the trend in new cases, in the United States, schools and businesses will likely remain shut, and most people will remain under stay-at-home orders at least into the month of May, maybe longer. The actions we're taking are helping to slow the spread of new cases, but it's also having a huge impact on the global economy. And then even whenever these restrictions on social interaction are going to be lifted, business will likely be conducted on a limited basis at first. And if we look overseas, China, South Korea, and most of Europe may be able to get back to some level of activity by May, but their economies are going to be hindered by a lack of export demand to the United States if the restrictions are not lifted here. So even after business begins to open in the United States, there are likely to be limits on activity, which I've listed here. For example, a limit could be placed on the number of people in a restaurant or a theater at any one time. Older people might continue to be encouraged to stay at home because they are the most at risk of mortality. Work from home arrangements and limiting travel to other states might become the new normal. And so as a result, the recovery and growth, even after business activity begins again, the recovery and growth will likely not be as robust as other prior recoveries. Now, I'll remind everyone that things are changing so rapidly that any forecast on future growth is not reliable at this point. But it seems reasonable that these types of structural changes could alter the trajectory of growth. It's clear that severe damage is being done to the economy, and the impact on growth could last longer than some might anticipate. On the next slide, so this much we do know. The US government reported a total of 3.28 million people filed for unemployment insurance in the week ended March 21st, which was at that time an unprecedented surge in the number of people seeking jobless benefits. And then this morning, it was announced that another 6.6 million people filed for unemployment insurance. So we're having people filing for unemployment insurance at unprecedented levels the past 2 weeks, and that's likely to continue over the next several weeks. Just to give you some perspective, the prior high, which was back at the beginning of the financial crisis in 08 and 09, was just under 700,000. So you can just see what a huge shock this has been to the system. Just 3 weeks ago, jobless claims were at a 50-year low of 211,000. And there could be another jump in the numbers next week. One of the things that I think is interesting on this chart is that the gray bars highlight periods where the US was in a recession. And so you can see typically whenever jobless claims rise, a recession follows shortly after. And we anticipate that this current period will be no different. The numbers for the unemployment rate may rise dramatically. I've seen a lot of estimates that a lot of people are putting out there. The St. Louis Federal Reserve is actually suggesting that the unemployment rate may hit 32% for a short time. I mean, just stop and think about that. Almost a third of the people in the workforce would be unemployed. Now, a lot of the other estimates I'm seeing aren't that drastic, but it still seems likely that we're going to see a unemployment rate at double digits, potentially in the 15 to 20% range. And after historically low levels of unemployment, that's quite a shock. While we've had economic slowdowns before, the main difference between this and other economic shocks is the suddenness with which it occurred. Business activity in the US came practically to a halt in just a few days. Consumer spending was rising through February, but now it's likely to take a drastic hit. So on the next slide, let's take a look at what some of the other economic data looks like in the second quarter. Global growth probably declined modestly in the first quarter and then will drop substantially in the second quarter. The industrial, manufacturing, and consumer data points released over the past few days really is almost meaningless because it doesn't include the full impact from the global shutdown. Economists expect the economic outlook to get worse nationwide as many of the country's manufacturing plants, particularly in the automobile industry, are temporarily closed. Other sectors of the economy, including retail and many services, will also likely contract during the quarter. So some of the estimates that we're seeing right now, global GDP, which had been expected to grow somewhere in the neighborhood around in excess of 3%, now is likely to drop 10% in the second quarter. But most economists expect a recovery in the second half of the year to bring GDP growth for the full year into positive territory. But still, estimates for GDP obviously have been reduced drastically. And for example, U.S. estimates were around 2%. Now they're anticipated to be right around flat or potentially even down. That positive 0.4 was several days ago, and as the business shutdowns and the social distancing gets extended, the numbers keep getting ratcheted down. So again, these numbers are very fluid, but aggregate estimates for Europe are now saying that GDP will grow around 1%, which is down from over 3% before. And China is now around 3% for the full year, down from over 6%. So already growth is being dramatically reduced as far as the expectations for GDP growth, and that's likely to continue. Corporate earnings are also set to drop substantially in the second quarter, somewhere around the neighborhood of 10 to 15%. Restaurants and theaters are likely to have their earnings just about wiped out. A rebound in earnings is likely in the second half of the year, but there are some serious headwinds, which I'll talk about in a few minutes, that may limit the extent of the rebound that would occur in the second half of the year. So on the next page, I just want to remind you that these are estimates, and there's a high level of uncertainty in what will actually happen to economic activity from now to the end of the year, because there are many questions where the answers are unknown at the current time. And I've listed some of them here, and the answers to these questions will in large part determine not only how deep the recession is, but also how much of a recovery we have. When will cases and the mortality curves begin to trend downward? We're already seeing some evidence of that occurring, but it's a question as to when the curves for many areas are going to begin to trend downward. And then once that does happen, how soon can we get back to normal business activity? And even more important to me is, what will normal even look like after this experience? How much damage will be done to the economy before that happens? And will the government stimulus enable corporations and small businesses to survive until they can operate again? Now, obviously, this is a lot of uncertainty. And if there's one thing that stock markets do not like, it's uncertainty. And so with so much that is unknowable at this time, it seems likely that stock markets will remain highly volatile the rest of this year, and probably longer than that. And we're going to talk a little bit more about what that might mean. So on the next slide, I touched on what some of the longer term economic fallout may be. And here are just some possible outcomes that may hinder the recovery indefinitely into the future. Unemployment could remain elevated as companies, even after this is over, become reluctant to add back staff. People may decide to travel less. There are many events that were live that have been canceled and cannot be rescheduled, concerts and other sporting events, and that's revenue that potentially will never be recovered. And even whenever they do reschedule these events, will people want to go to them? Will people want to be at a concert with thousands of other people? Again, these are questions that are unknowable at this point, but if these trends do become a reality, then the demand for goods and services could remain weak and inhibit the economic recovery even after the pandemic is over. Companies, as I said before, have already lost some business that they'll never get back. For example, as we move forward, a lot of businesses may need to rethink their supply chains by shortening them and avoiding countries who may be at risk for future pandemics or other types of economic shocks. They may limit their expansion into China. Global trade was already shrinking, and so this could accelerate that trend and cause people to do business closer to home more often. So while the recovery is likely to begin in the third or fourth quarter of this year, for these reasons, we believe that it might be somewhat of a weaker recovery than after other economic shocks have been historically, because economic activity might not bounce back strongly. So on the next page, just to illustrate some of these challenges, Bespoke Research did a survey that shows what the economy may look like after the pandemic is over. And the results on the bottom of the survey will likely subtract from growth going forward, and the results on the top of the survey will likely add to growth. And so what they did was they asked people going forward, do you expect to do each of these activities more or less because of the impact that the coronavirus has on your life? And what it showed that, if you look on the bottom half, consumers will likely travel less and go to a store less often. People will likely do recreational activities outside the home less often, and they may go to fewer live events. Some of the things on the top of the chart that will partially offset some of these economic negatives are that people will use streaming services and social media for entertainment more often, and they'll shop online for groceries and other items more. In many cases, these are trends that are going to be accelerated that were happening anyway. But the net effect is going to be lower economic growth because the things that people are likely to do more of are less expensive than what people are likely to do less of. For example, streaming services are cheaper than going to the theater or a live concert. There's potentially going to be less need for Uber or automobiles as people stay home more often. So all of these things are part of the reason why we think that the recovery might not be as strong as anticipated. So if the COVID-19 pandemic wasn't enough to rattle global stock markets, Russia and Saudi Arabia decided to use their oil production to fight for market share. Russia refused calls from OPEC to cut production in order to support the current price. Both Saudi Arabia and Russia then decided to flood the world with oil to drive down prices and increase their market share. As a result, the price of oil plunged more than 40%. And you can see on the chart, it was down. It actually did touch around $20. Now, just to give you some perspective on that, the U.S. shale industry needs prices to be somewhere above $45 a barrel in order to maintain production. So a lot of people believe that the actual target of both Saudi Arabia and Russia is the U.S. shale producers. So they are likely to feel some pain, and there are likely to be some bankruptcies in the U.S. shale industry. U.S. oil producers are also feeling the pain, and their debt is getting downgraded as the likelihood of many of them going bankrupt or defaulting on their debt increases. So what does all this mean for stock and bond markets going forward? On the next page. The combination of the shutdown of most of global economic activity and the price of oil plunging has caused a historical amount of volatility in stock markets. First, stocks plunged, entering bear market territory of a 20% drop in the shortest amount of time in history. Then stocks continued to fall, dropping over 30% before rebounding. Then, after the government appeared close to passing the stimulus package, stocks recorded their biggest three-day rally in history. And so what I have here is a chart of just a sample of a period during March where there was some historic market volatility. So this is the daily returns of the S&P 500 beginning in the beginning of March through the end of March. Over the last 30 years prior to this March, global stocks had one-day price movements more than 4%, only 65 times in the 30 years, or less than 1% of the total number of trading days. In March alone, there were 13 days with one-day price movements, either up or down, of more than 4%, or about 60% of the total trading days. So again, this is a historical level of volatility. And going forward, I believe that volatility is likely to continue. So we have had a sharp rebound in prices off the lows, and then we gave a little bit of that back. But we have seen the volatility continue as the news flow continually changes. There is the potential that bad news regarding the pandemic or the oil market could cause stocks to move lower once again, as we saw happen yesterday. And if you look back at history, historically, such strong bounces in very short periods of time that we saw, that 20% rebound in 3 days, haven't lasted long. And so, as an example, as a couple examples, the other two biggest 3-day surges in stock prices took place in 1931, at the start of the Great Depression, and in 2008, in the middle of the financial crisis. Both of those rebounds didn't hold. So I don't believe that we're out of the woods yet. So another outcome is that during times of stress, correlations between asset classes tend to rise as everything gets sold. Even those safe haven asset classes can get sold. And so on the next page, if you take a look at some of the performance of some different asset classes, you can see how in the 10 years leading up to 2019, the S&P 500 dominated every other asset class. However, during the sell-off, in the very short time period, international stocks, commodities, emerging markets, even though they trailed domestic stocks during the 10-year time period, whenever everything sold off, they sold off with the S&P 500. And then during shorter time periods, the sell-off even struck the bond markets as even investment-grade bonds sold off. And what happened was businesses were finding it difficult to get the funding that they need for their daily operations as banks stopped lending and extending lines of credit. And as a result, in order to get liquidity, they sold even safe haven assets like treasuries, municipal bonds, and gold. And as I'll talk about, that's one of the reasons why the Federal Reserve stepped in to provide the liquidity that was necessary for the markets to keep functioning. So on the next page, how are the governments addressing these issues? Many countries around the world are applying monetary and fiscal stimulus. The US Federal Reserve responded to these issues that I just talked about by flooding the market with liquidity. Some of the things they did to make sure that the businesses were able to keep functioning is they extended loans to bigger banks in the hope that they will continue lending. The Federal Reserve began buying commercial paper, mortgage-backed securities, and treasuries to provide the short-term funding that businesses need and to keep the financial markets operating. Many countries around the world are also applying stimulus. China announced cuts in the required rate of reserve paid by some banks. The Bank of Japan, Australia, Indonesia, and the EU all pledged to inject huge amounts of cash into its financial system. And that has eased tensions somewhat, but banks are still hesitant to lend with the business climate so uncertain. So the US government also passed a stimulus bill. The reason why all this liquidity is needed is because the shutdown of business activity created a mismatch between income and expenditures for both consumers and businesses. In a functioning economy, there's a match between income and expenditures. As long as any short-term mismatch is predictable, both consumers and businesses can plan for that mismatch and continue to function. But if a short-term mismatch is not predictable, then consumers and businesses cannot get the cash they need in the short term to stay solvent. And that's what happened because of the pandemic. It's been a very sudden, unpredictable mismatch between incomes and expenditures. And so all of this government stimulus is intended to fill in that income gap so both consumers and businesses can remain liquid until we get back to work again. On the next page, this stimulus has provided a backstop to keep the economy running until we get back to some level of economic activity. And this has enabled investors to begin to look beyond the pandemic and look at once this is over, and we do anticipate it's going to be a short-term issue. Now, a lot of people would debate what short-term is, but even a 3-month pandemic is relatively short-term in the long history of the economy and the stock market. And so looking at this chart does provide some comfort, because this chart, which comes from the JP Morgan Guide to the Market, shows that throughout history, stock markets have withstood famines, pandemics, world wars, and financial crises. And through it all, stocks have always recovered and moved higher eventually. And while that's comforting for long-term investors, it doesn't give much insight into how long the current market volatility might last until it does fully recover, but it does indicate that with the downturn that we've had, the risk return profile is beginning to favor equities for long-term investors. So to provide a little more insight, the next chart comes from Morningstar, and it provides some insight into how long it took a balanced portfolio to recover after prior market shocks. And so what this shows is several market shocks in the past, starting with the October 1987 stock market crash and going across the bottom. And it gives the stock market performance 1 month after the shock, 6 months after the shock, after 1 year, after 3 years, and after 5 years. You can see the legend in the top middle where it's listed. And it shows the hypothetical performance during those time periods of a balanced portfolio. And the thing I thought was interesting about this was even during times when the market rebounds during the first 6 months after a market shock, the portfolio is lower 1 year out from the event half the time. So half the time, the initial rebound that you might see after a market shock doesn't last through the next year. However, once you get further out into 3 years and then especially 5 years, it's much more likely that stocks are going to be higher than they were after the market shock. So these patterns can be very instructive at the current time because we believe that the recovery is going to be a long, slow process as people attempt to get back to normal, whatever normal ends up being. And as I said, it may be some time before people are willing to travel and spend as they did before. And corporations will need time to rethink their business models. Businesses may increase the use of technology to facilitate meetings instead of traveling to different sites, for example. So prior to the pandemic, growth in economic activity around the world was improving about at a 3.5% rate globally. And it may be some time before total growth gets back up to that same level. However, we do believe that stocks will rebound and eventually recover, but it might take some time. Then on the next slide, 19, while the current pandemic is of the utmost importance to everyone, it's important to remember to adhere to your long-term strategic allocation and not try to time an exit from the market and then a subsequent entry back into the market. And this slide and then the one after it demonstrates why that is. So this chart shows how much investors potentially cost themselves by trying to time market movements. The two examples that it shows here of trying to time the market are two reasonable scenarios that what investors might do. Now, obviously, there are many different scenarios that as to what an investor might do. These are just two of them, and they're fairly reasonable. The first one in the light blue is that they stay invested in the stock market. Then the first market timing example is they exit the market and reinvest after 1 year. The second example of market timing is exit the market and invest in cash. You can see how much money this investor, if they would have done either one of those two market timing scenarios, how they would have damaged their overall net worth in the long run. The next chart shows a little more of a concrete example, which is based on actual data. It's based on actual mutual fund flow information during and after the most recent financial crisis. So this chart comes to HBKS from Allianz Global Investors. And what they did was they took fund flow information from Morningstar, and particularly the funds into equity mutual funds and out of equity mutual funds. So you can see the bar charts in each year represent the fund flows either into or out of equities. If it's above zero, it's a flow into equities. If it's below, it's a flow out of equities, on average across all of the mutual funds that Morningstar covers. The dot is the S&P 500 performance for that given year. So what I find fascinating about this chart is that investors didn't sell out of the market until a lot of the damage had been done in 2008. And then after they, on average, whenever they stayed out of the market based on the flows remained negative for the next 4 years while the market was recovering. So people were not putting money back into the stock market net across the system. On net each year, they were actually taking money out of the stock market as the market was recovering. And it wasn't until 2013 where people finally began to take a step back into the stock market. And so the damage that these people did to their long-term net worth by not being invested during the recovery phase, the initial recovery phase of the 4-year period from 2009 through 2012, could have potentially really damaged their long-term net wealth. So on the next page, at HBKS, we have prepared our clients for events like these, so they don't need to try to make these types of timing decisions. Our investment process begins with a thorough assessment of the client's goals, need for cash, and tolerance for risk. We only recommend a portfolio to a client after we assess their entire financial situation, including income and expense expectations. This financial planning is done to help design a solid plan based on long-term goals and should not be influenced by the daily fluctuations of the stock market. This approach is very disciplined and includes designing a portfolio with a long-term strategic allocation, doing a risk tolerance assessment to ensure that our clients are in an appropriate mix of assets, and also do an assessment of the timing and amount of financial commitments to ensure adequate cash. So on the next page then, after we begin with that financial planning process, we then move into our investment philosophy. And the HBKS investment philosophy is rooted in the belief that markets are unpredictable. We do not believe in trying to time the market. History has shown it is impossible to predict future prices on a systemic and long-term basis. Now, that being said, our objective is to provide a return that enables our clients to reach their financial goals while limiting the negative impact of a market downturn. To achieve this goal, we actively manage the risk profile of our clients' portfolios. And the primary way we manage risk is by having a globally diversified portfolio across many asset classes. And this includes asset classes that are not highly correlated to traditional markets. And it also includes utilizing both passive and active management, because our studies show that active management does add value in certain asset classes. And I'd like to just expand on that a little bit, starting with the next slide, because I think this is an important part of what we believe, especially in the current market environment. If you look at most of the studies that talk about active versus passive management, they will indicate that actively managed mutual funds fail to consistently beat their benchmarks. But if you look more deeply into those studies, most of those studies don't use an appropriate benchmark. They'll look at every benchmark, regardless of whether it's large cap, mid cap, small cap, foreign, domestic, and they'll compare it against the S&P 500. The other thing they do is they include every fund in the universe of funds, including very small funds with inexperienced managers that an investment professional like HBKS would never invest in. So I understand why those managers would be included in individuals' studies, but if we're doing the study, why would we include managers we would never consider? So we removed all small managers, all managers with less than 5 years of experience. We calculated the average fund performance in each category, and then we compared them against an appropriate benchmark for their asset class. And what we found on the next page, and I won't go through this as in depth as I normally do, but basically within the large cap domestic and mid cap domestic asset classes, we would agree that it's hard to find an active manager that would outperform over the long term. So we use mostly passive investments in the large cap domestic and mid cap domestic space. But once you get outside of the large caps and mid cap domestic space and get into small caps and foreign investments, your probability of finding an active manager that can beat its benchmark increases substantially. And especially if you look at those last two columns, if you look at down markets or periods of relatively flat returns, even in the large cap and mid cap, it makes a case for at least some level of active management. And I would say that in the current market environment, as we come out of this, the type of managers that we think are going to do well are those that are focused on high quality types of companies with consistent cash flow and low debt. And so an active manager in that type of environment can identify those companies while a passive index cannot. So we think it's very important going forward as well. And then the next page just gives you a framework for how we put together our asset allocation. And so whenever we think about the assets that we're putting together into a portfolio, we think in terms of risk generating assets and risk management assets. And so all of our clients, regardless of what their risk tolerance is, will have some blend of these two types of assets. Obviously, the percentages in each will be dependent upon what their risk tolerance is, but all of our clients will have some return generating assets. And by that, I mean equities, both US and foreign, and real assets, investments that are primarily intended for long-term growth. And then we will also include a portion of risk management assets, which are primarily intended to reduce the volatility of the portfolio without sacrificing long-term growth. And in that category, we would include all types of fixed income and also alternatives. And I'll talk a little bit on the next page about alternatives, because I think that is an important part of our philosophy. We consider alternative asset classes to be any asset class that has a return profile it has a low correlation to the traditional asset classes of stocks or bonds. And we use these asset classes as a means of diversification and lowering the overall volatility of client portfolios. And going forward, we think that they also potentially represent an opportunity to increase the expected return of portfolios, because these types of alternative asset classes in a very volatile market environment not only reduce that volatility, but also have the potential to outperform the traditional asset classes, so they can also increase the expected return of a portfolio. So on the next page, what is an investor to do in the current climate? If a client is working with HBKS, the answer is stay the course and remain focused on your long-term goals. Historically, it's been proven that it's nearly impossible to try to time the markets. It's also not a good thing to try to trade during periods of stress, because it's possible the prices of the assets you're selling are going to be negatively impacted. But there are some modest changes you can make within the framework of your long-term allocation. Once the COVID-19 curves flatten, as we talked about earlier, it makes sense to rebound back to your targeted equity exposure and even modestly raise the targeted allocation to equities to companies with solid, consistent cash flows, as I mentioned before. But remain broadly diversified amongst the many asset classes, but just raise the target specifically to those equities. And remember, if you are an HBKS client, it's likely that your advisor has done a financial plan for you. And the financial planning software performs Monte Carlo simulations that provide the probability based on 100 different market scenarios of you achieving your financial goals. This simulation takes into consideration market environments like the one we are currently experiencing. And so if you had a high probability of achieving your financial goals before this year, it's very likely that you still do. So on the last page, I encourage you to talk to your financial advisor if you have any concerns or if you want to revisit your financial plan. Also, you can go to hbkswealth.com to see some of our latest thoughts on this and other issues. And with that, I'd like to open it up to questions.
Thank you, Brian. We've received a number of questions from the attendees. I'm going to start with this first one. Once the stay-at-home orders are lifted, how quickly will the stock market bounce back?
Yeah, that is the million-dollar question, and you might see in the media a lot of letter-shaped rebounds talked about. They talk about a V shape, which would be a very quick rebound, a U shape, which would be sort of a longer, slower bottom before we rebound. Then there's some people saying it's going to flatline and we're not going to see much of a recovery at all. So it's highly uncertain, but our best estimate right now is that we're going to see, we would tend towards the U shape, where we're going to see, once we get back to work, a lot of the factors that we talked about earlier cause the recovery to be slower than some of the prior recoveries of that happen more of a V shape. But once we get into the second half of the year, we are going to begin that recovery. And as we begin that recovery, that's whenever the stock market should move. Remember, the stock market is a forward-looking type of vehicle. And so they're always looking at not what the current conditions are, but what's happening, what's going to happen a month from now or 2 months from now, or even further down the line. So as soon as we begin to see any small improvement in the data, we could begin to see the market moving very strongly. But that doesn't mean that we're off to the races and that necessarily if we see another 20% rebound, that's going to hold. Because the recovery is going to be slow, it's going to be choppy times for a good bit of time going forward, we believe.
Okay. The second question is, as we are looking at investment opportunities, are we actively identifying companies who are likely to emerge successful after this pandemic?
Yeah, so that gets to some of the discussion that we were talking about active managers. So what we do at HBKS is, we look at each asset class and we buy or we will invest our clients' assets in those managers after an intense amount of scrutiny, have a history of solid performance, and we believe have a process in place that are going to continue that performance. And so what we are currently doing is we are talking to our active managers, because we do believe that active managers who have the ability to buy companies that have low debt, have solid cash flows, and a very high quality of earnings are going to be the types of managers that outperform going forward. So we are definitely looking at those types of managers at the current time.
So along this line of questioning, we've received some questions about certain industries and how they will perform. So the first question is related to the GDP, the impact on the GDP, and how we anticipate companies within financial services, life insurance, annuities, et cetera, performing. So as a sector.
Yeah. So as we're looking at sectors, the two sectors that have been hit the hardest have been the energy sector, for obvious reasons, and also the financial sector. And so as we go out of this pandemic and get into more of a recovery mode, we believe that financial stocks in particular are extremely inexpensive, and their systems are strong. The government is going to make sure that they remain strong. And so we think that there is an opportunity for those stocks in the financial sector to, particularly the banks, to do well going forward. The insurance companies are another story. There's a lot of uncertainty there with what type of liabilities they're going to have, and so that's an area that, at least at this time, it deserves some closer scrutiny.
Similarly,
healthcare.
I'm sorry. Go ahead.
I'm sorry. I was just going to say healthcare is another area that we think is going to do well. I think if there's one thing that this pandemic has done, it's shed light on a lot of the good work, that research work that's going on in the healthcare industry, and I think there's some opportunities there.
Brian, what about the effects on the retail brick and mortar landscape and the restaurant sector? What do we potentially see might happen after this, as a result of this pandemic?
Yeah, that as I said earlier, those are areas where their earnings are not only being hit, their earnings are practically dropping to zero because of this pandemic. And there would have been a lot more failures and bankruptcies if the government hadn't stepped in and done the $2 trillion stimulus package. And they're likely to do more. There is already talk about another stimulus package that is in the works. And so the reason why that's so important is that a lot of these industries that basically have had their revenue cut practically to zero, they need a way to get through in this pandemic. And as I said, even after we do get on the other side of it, people potentially could be hesitant to begin going to restaurants again and begin traveling again and staying in hotels. And so I do think that could be an area that does struggle for some time.
Okay. We've gotten a number of questions about cash and whether or not this is a good time to invest excess cash that you may have.
Yeah, that is an extremely difficult question because, again, we are the only way to determine when the stock market is attractive is taking a look at what are future earnings and then discounting those earnings back to the present and seeing what the valuation is. And without much visibility into what earnings are going to be with all of the uncertainty of all the items we've talked about, it's really difficult to say when an appropriate time to get into the market is. I think a lot of it would depend on each person and their own individual risk tolerance. I would say, however, that if you do look at the stock market on a historical basis, after such a large drop, I think that it does make sense to at least continue. If you have any pre-planned plans to get money into the stock market, if you're dollar cost averaging in, I would continue doing that. And I do think that once we get to a point where the pandemic, the COVID-19 curve begins to show the trend that it is actually flattening and potentially moving downward, it could be a good opportunity to put a little more to work into the stock market. But I think we're a little bit early at this point.
Okay. Another question from our attendee group, what will the long-term effects of the fiscal stimulus and QA have on the value of the US dollar?
I'm sorry, I didn't catch the beginning of that. Could you ask it again?
Sure. What will the long-term effects of the fiscal stimulus and QE have on the value of the US dollar?
Yeah, that's something that a lot of people, the effects that all of the stimulus has, or potentially could have, is something that not a lot of people are talking about yet, because obviously it's something that most of the world believes is necessary at this time, and we'll deal with those factors whenever they happen. It is likely, though, that they would have the effect of potentially weakening the dollar longer term, which I think potentially could mean that there are some opportunities with equities overseas, and particularly in the emerging markets, longer term.
Okay. Another question from the attendees, one of the attendees, you had mentioned that global trade was already shrinking and could do more. How will that affect strategic investment planning in managing risk through global diversification?
So I think it will potentially make investing in foreign countries even more important, because one of the arguments against investing in foreign companies before has been, well, if you invest in many or most U.S. countries, they have a large portion of their revenue from overseas anyway, and you're getting that exposure. And so potentially what could happen is that more countries will turn inward and focus on their supply chains inside of their existing country. And so what's going to happen, though, is that you're going to have to do a lot of analysis on the economies for that specific country that you might be investing in. But to get that exposure, you're going to need to go overseas to invest.
Okay. Here's another question for you, Brian. What is the best hedge against the current volatility in the stock market?
So there are a number of ways that you can hedge against the volatility, and there are short-term hedges and there are long-term hedges. And so in the short term, having an exposure to fixed income, in particular, core bonds, is one of the best hedges that you can have. If you look at during the real periods of market stress, while there was a short time where bonds sold off, in general they held up pretty well and provided a good buffer. So I think short-term bonds, longer term, some of the alternatives that we've talked about have the opportunity to be not as exposed to the certain risk factors that either stocks or bonds are exposed to, and can potentially add value over the longer time frame as a hedge.
Great. Another question, Brian, and we have time for a few more. This one is timely in that this is an election year. So the question from one of the attendees is, how will this being a presidential election year affect the market?
Yeah, that's a really difficult question to ask. I mean, typically the fourth year of an election cycle is a positive year for the stock market, because under normal times, the party that's in power will do everything they can to make sure that the economy and the stock market is in good shape in order to enhance their reelection. With this pandemic, it really all bets are off at this point. How it could potentially, how the presidential election cycle will play into the pandemic and the potential recovery. It's really impossible to tell at this point. It really is. There's just so much uncertainty of what could happen there.
Fair enough. We've gotten a couple of questions about whether or not the negative strength of any daisy chain of such failures could produce another serious recession or depression.
So what was the first part of that again?
Effectively, are we headed into, a serious recession or depression?
I see. Yeah, we believe that we're not. While this has been obviously a very severe shock, and as I talked about earlier, the numbers are going to get really ugly over the next month or so. Unemployment is going to skyrocket up, double digits, and we are going to enter a severe recession. But that being said, I think it's going to be a short-lived recession. And so with all of the government stimulus that has been able to, should be able to hold the economy intact and wait until people get back to work, and then whenever we are able to ease some of the restrictions on social distancing and people are back out generating activity again, I do think that the recession will be short-lived and we will be in a recovery mode by the end of the year. But again, it's going to be a low, slow, long recovery, but it will be a recovery. I think the recession will be short-lived.
Great, and we have time for one more question, and it's related to some of the recent conversations about investing in America and putting some money up against special projects to repair bridge, roads, tunnels. Do we think this will help accelerate recovery?
Yes, any type of government stimulus package definitely would help in the short term, and a stimulus package that would focus on rebuilding the infrastructure is, in my opinion, probably one of the best ways that the government could help the recovery once it gets back to work, because it would hopefully, if it's done right, should create jobs and get people back to work much sooner than they normally would have. So I know that's being talked about right now at the current time, and I would hope that they are able to pass some sort of infrastructure bill very soon.
Great. Well, thank you, Brian. Unfortunately, we are at time, and we're unable to get to everybody's questions, but wanted to let the attendees know that we will follow up directly with any additional information related to your inquiries. And as I've mentioned, a copy of this presentation as well as the recording will be sent out later this afternoon. So thank you, Brian, for this very insightful discussion this afternoon. And thank you all attendees for participating. We wish you well and stay healthy. And please, if you have any specific inquiries, reach out to your HBKS advisor. Thank you, everyone. Have a great afternoon.